Welcome to QuickBooks at Kapiolani Community College. This video will go over Chapter 5, which covers general accounting and end-of-period procedures for a service business. There are several areas in your chart of accounts that you may have encountered already, or you may have never encountered if you were very careful and made very few mistakes. One of those is whether you want to make an account disappear from your active transactions. Now you can make the account inactive, and all that does is removes it from your visible selections whenever choosing accounts for entering transactions. For you to delete an account, that account really can't have any transactions in it, and that would mean that you've never assigned it a beginning balance, and you've never made any entry that included that account, and you've any entries that might have been made to that account were reclassified to other accounts, taking them entirely out of there. Even then, sometimes it's sticky and doesn't allow you to do a deletion. Alternatives to deleting are to make the account inactive. That would have to be a zero balance account, and then it won't show up on reports. If it has still balances, it'll still show up on reports. Or you could merge this account with another account that you do want to keep. The problem is if you try to delete an account which has a balance in it, QuickBooks will make an offsetting entry for that account deletion, which means essentially it's still stuck and doesn't let you get rid of it. So that could be a frustrating situation. You should ask for advice from me or assistance if you've had any of these problems. Now, end-of-period procedures are very important for all accountants, and one of the major things that you do have to do at end of period to make your financial statements more correct is to do adjusting journal entries. In Chapter 3 of Accounting 201, there was a substantial amount of content there, and there were review materials that I placed up there for Chapter 3, so you can go and delve into them if you need a little bit of review. In QuickBooks Online, you make journal entries from the plus icon up in the top right corner of QuickBooks, and select the other column and journal entry. You can also go directly to an account register, and as far as entering a transaction, it'll allow you to make a journal entry. Now this must be done from an asset, liability, or an equity account. For adjusting journal entries, those always involve revenue or expense, and you're doing it to make the account more accurate as of the period, and also to make more accurate your current assets and current liabilities and or accumulated depreciation. Now when we have accrued revenues, that's where you have revenue first at the time of the adjusting entry, the current period, and cash won't be received till later. So this would be for like a partially completed contract where you want to pick up part of the revenue included in the current period because it's been earned. Interest that's been accrued, say on a note receivable, but not yet received and won't be received until the note matures. Deferred revenue is where you've already received cash, perhaps earlier this period, perhaps in an earlier period, and you won't receive revenue till sometime after that, which would be at the end of this period or during this period, having received the cash earlier. It should technically go into an unearned revenue liability account, but QuickBooks handles it like it's a credit balance on accounts receivable. If you were doing total GAAP financial statements and you had a substantial amount of these deferred revenue items, CPAs would want you to reclassify them into a liability account, unearned revenue. However, small amounts you can leave buried inside of accounts receivable. So to do this, you'll have a debit to accounts receivable for the customer's name and a credit to the revenue account when you actually make the adjustment for the finally unearned revenue. So it kind of looks just like a regular adjusting entry, except all it really is making a bill, an invoice for the customer prepayment is what it amounts to. Accrued expenses are when you have an expense first and cash won't be paid till later. So you debit an expense and pick up an account payable for the amount due. This would be, for example, a partially completed contract where somebody's providing a service for you. Deferred expenses are those related to something where you've already paid for the item and purchased it, for example, insurance coverage or supplies, and now you're using that thing up. So you create an expense at the time you use it up. Depreciation is just a special form of deferred expense. We paid cash a long time ago for a substantial asset that's going to last multiple years, and then each year you're counting part of its cost as an expense called depreciation expense. So the name of the fixed asset account, whatever that is, equipment, depreciation, is the depreciation, accumulated depreciation account. And that's a contra asset type of account. Now, if you are the invited external accountant for someone else's books, you can make what are known as adjusting journal entries by QuickBooks, and those are available for you as in the external accountant role. They get flagged as adjusting journal entries. So if you were to ask for an adjusted trial balance report, that would pop up in the adjustments column of that report. In QuickBooks Desktop, you don't have to be, you would just need the accountant's edition of QuickBooks Desktop, and you do a checkbox for the desktop version of QuickBooks adjusting journal entries. But for online, you need to be the external accountant role. So if you were working as at a CPA firm, or if you were a QuickBooks Online Pro Advisor, this would be when you would use the AJE selection. Bank reconciliation, a very, very important step in maintaining control over cash and also having correct books. We use it to verify cash transactions by reference to some kind of externally generated source. So that gives us a good idea whether or not our internally recorded transactions are correct. So a traditional bank rec looks like this. There's a bank side where you have the balance according to the bank statement, then the balance according to the books, and they're typically not the same. And there are items that you would add or subtract on the bank side to get to what's known as the adjusted bank balance. So uncleared transactions like outstanding checks or deposits in transit, or corrections plus or minus for any bank errors that were made. On the book side, you have reconciling items amounting to anything that you need to fix that wasn't recorded, or anything that you made an error in that needs to be adjusted to or changed. So then you end up with the adjusted book balance. So missing service charges, customer NSF checks, checks or deposits recorded in the wrong amount. So when you do this traditional bank reconciliation, the adjusted bank balance and the adjusted book balance are supposed to be equal, and you make adjustments to the book side via correcting or adjusting journal entries. So if you were working on a client's books as the external accountant, you would do that. You wouldn't go in and try and make entries directly to their books. If you're the internal accountant and it's your company's books, then you'd go back and correct the transactions that need correcting. Now, for this traditional bank rec, only transactions up to the balance sheet date are included, and the adjusted balance is what you see on the company's balance sheet. Now, the QuickBooks format is quite different. You have the beginning balance, which was your last period's ending bank statement balance, and then they'll recap all of the transactions that happened during this month. Cleared transactions are those things that appeared on the bank statement and on the books. So you'll see checks and payments subtracted, deposits and credits added, and the new cleared balance, which is the same as the bank statement balance. So basically, it arrives first at the bank statement balance, and then it takes from the bank statement balance any uncleared checks and payments and adds to them any uncleared deposits and credits to get the balance that's your latest balance on the books, which is up to the day that you're doing this reconciliation. So if you're doing this reconciliation on the 4th of the new month, then the register balance will be as of the 4th of the new month. So your cleared balance and your bank statement balance have to be equal. If they're not, then something's wrong. And when necessary corrections to the book side have to be spotted, you can pause that reconciliation and go ahead and make the entries into QuickBooks as long as it's your company's books. Now, the register balance as of the period end shows up on the company's balance sheet, and this is probably not the same as this last book balance here because this is as of the day you do the reconciliation, not the closing date of the accounting period. Closing entries, a very important step for traditional books. Not as big a thing for QuickBooks because it doesn't actually close in the same way. In closing entries for a normal set of books, we eliminate the balances of all the temporary accounts, update the balance of the equity account, and so for a proprietorship, our temporary accounts revenue, expense, and drawings would get closed into owner's capital. In a corporation, the same accounts, revenue and expense, and also the dividends would get closed into retained earnings. In QuickBooks Online, it will quote-unquote close your revenue and expense into retained earnings for you at period end. It doesn't really make a closing entry. It just, on the first report of the following period, the revenue and expense are no longer there. They've been absorbed by the retained earnings account at the end of the period. Now you can always generate a report for a custom date and show your income statement for any period in this kind of a setup, so that's partly why it's made so flexibly. Now in a corporation, a retained earnings account is part of our stockholders' equity section. In a proprietorship, there isn't any retained earnings account, there's only the capital account. So for you to get the balance sheet of a proprietorship looking the way it should be, you need to make journal entries to get rid of that retained earnings account. And if there's drawings, you need to get rid of them too. The net income and retained earnings get closed into, if there's any remaining retained earnings from prior period, would get closed into capital. If it's up to date as of the end of the last period, then you'd only close the net income. So the debit would be to retained earnings and the credit would be to the owner's name capital. So retained earnings would get zeroed out because of that. Capital would include the net income amount. Now the drawings account also gets closed into capital, and it will be done automatically by it would get closed into retained earnings rather, so you want to get it closed into capital instead. So you debit capital and credit drawings. Now at the beginning of the first following period, the net income and the drawings will show up as part of owner's name capital, so they won't be around anymore. But if you were to ask for a trial balance for the current period, you would still see revenues, expenses, and drawings on that trial balance. So your retained earnings will only include this debit, and so the retained earnings will appear to be negative on the trial balance. So closing your books in QuickBooks Online involves really just setting over 2 possible permission levels for the period, for access to entries in the period. And this is super strongly recommended if you're working with a company's books, especially one where you're outside the accountant or their pro advisor. The lowest level of permission is allow changes after viewing a warning, which is kind of like a nuisance thing, like, are you sure you wish to download this file? So most unskilled users would just say sure. The other level of permission is allow changes after viewing a warning and entering a password. That's the highest level of permission, and this is what I recommend you would set. And many times you'll get all sorts of grief from the internal accountants because this is a real pain for them to have to like mess around with the password. I heard an online conference one time, and the pro advisor said, the client asked him, what is the password for getting into the closed period? And he said $1,200. And the client said, excuse me? And he said, $1,200 is the password. She said, why did you pick a password like $1,200? He said, because that's how much it's going to cost you for me to find out what you messed up when you made the entry to the closed period. So that's all kinds of things will get messed up. Here you go. If you make entries into closed period, this causes errors in the bank reconciliation every time. This assuming we're talking about some kind of check or deposit. Retained earnings and a statement of retained earnings anytime the entry involves revenue or expense. If it's a tax return for a corporation, almost always will mess it up. Either the income level and or the schedule of balance sheet schedule that's a part of the tail end of the return. Payroll tax return if your entry involved payroll or payroll taxes. General excise tax returns when your entry involved either revenue or expense. So you want to always try to confine any modifications to these transactions from prior periods to some kind of asset or liability account, even if the original transaction was revenue or expense. So you do web searches asking for the procedure that you ought to follow and just include the term like closed period. Here's an example right here. Notice we want to void a check basically from a prior period, then we want to reissue the check. So the suggestion here is to make a deposit to another liability account now, and then issue a replacement check to that vendor now, and use the other liability account on the expense tab and make that dated now. So what this will do is end up with a net change of nothing and allow you to get rid of your old check. Hope this helps.